Hello and welcome to Options Guide TV. My name is Brian Overby. I am your host for about the next 30 minutes here on Options Guide TV. And gosh, I've never seen markets like this where it's just so news driven that it's hard to even look at the technicals. We saw it's befuddling with NVDA that they had amazing numbers across the board, both top line, bottom line, and even mentions of forecasting in the call afterwards. And the CEO had a special on CNBC, like 1 hour conversation, well, maybe a half hour conversation at prime time. And the stock ran up 5 after hours and then proceeded to close in the after hours market down a couple of points, went to the open the next day after the earnings, and the stock ran up 5 points again. And then the headlines started hitting about new tariffs, about Taiwan semiconductors, basically everything that was coming out of the White House. And the stock went from up 5 to down 12 by the end of the day. And now we see it bouncing back again. So I had a couple of positions on in my account, and I've had NVIDIA in my account for quite some time, and I think a lot of people have. One of the at one point in time, the biggest company in the United States as far as market cap is concerned. And now if I look at NVIDIA, I do think that this is an opportunity to buy some NVIDIA or to actually just flat out adjust your trade. So prior to President's Day, we looked at how do you want to hedge NVIDIA, how you can use put options to protect the position, how you could do covered call writing to try to bring in some income while you're waiting for the stock to come back. And then on President's Day, we actually reviewed the one trade that we did for the trade of the day, if you will, on Options Guide TV. We did in the show, we called it the covered call on steroids, which is a front spread. And if you own 100 shares of stock, this was a trade that you might want to do. And I do think the timing's right to do it again. In my mind, after that earnings report, I would have expected NVIDIA to move at least the expected move back up to the upside. The stock already had, it's not like it was strong going into earnings, and the earnings gave it every reason for the underlying stock to bounce back. Now it's trading as low as 26 times earnings at this point in time. So the news headlines are obviously driving the stock much more than the numbers are. And so I'd look for a bounce back. So we're going to do that today. And I don't mind looking at that trade. We're reviewing what we did before. And then also the IWM trade. Now, I don't know if you remember that we did a trade in the IWM, and it was just kind of an off-the-cuff trade. We looked at the chart in IWM, saw that it broke finally for the first time below the moving average. And this was also a confusing one to me, and I mentioned it on the show, in that the small caps you would think would have a lot of would be very susceptible to news headlines. Obviously, inflation is an important thing with the small caps. Other things, tariffs, trade wars, those can really affect the smaller companies than the bigger companies. But right now, it appears that most of the large caps are getting hit more by all of this conversation, and the IWM was just trading within a range, not doing too much. Finally got a little bit of a breakdown. We have a long put spread on, and we're going to look at that long put spread that we initiated. So to start, let's go into the IWM trade, and the NVIDIA trade that we set up before earnings, and I mentioned this, it's not going to pan out. Well, I guess you got a week, who knows, with that underlying stock and the way the markets are, with the VIX up above 20 at this point in time. Who knows exactly what might happen. if news came out that there was no tariffs that are going to happen with China and all that, which I don't think is plausible, but who knows? Who knows? Because if there's any positive news on that front, NVIDIA would, I think, would just skyrocket to the upside. That would be my forecast. Not meant to be a recommendation, but that's the direction, the path of least resistance. I think would be to the upside. Okay, IWM is at 214.08, and our put spread that we had on is, let me grab that real quick. Like we went out to March, we got a lot of time on this trade, so we gave some time for the trade to work out. March 21st was the expiration. We bought the 217 strike put, and that was basically right where IWM was at. And we sold the 203 strike put. So we still have a lot of time on the trade. We should at least look at the trade. And I don't mind actually sometimes rolling up, depending on where the 203 strike put is at. So we got 14 points wide. So let me set up the trade for you here. March 21st, expiration. There we go, 21 days away still. We bought the 217 strike put, and that's $6 right now. And we sold the 203 strike put, which was $1.70, right? And that was one of the things that we noticed, is that there is a pretty decent amount of implied volatility skew to the downside from 25 down to 28. And it looks like vols are just up in general across the board in this underlying. And we sold that one. So when we put on the trade, you could execute it for $3.53, and we're now up. Yeah, it looked like from when I took the screenshot, it was 353. So now we're at 438. So we're not quite up $1 on the trade. We still got some time left. If we look at the chart in IWM, and let's just leave it right there. But this is what we saw. This is where the stock was at right here when we did the 217 strike. I think it was right here. It broke down this range, and we bought it right on this day. And the market has shown a lot of weakness going into it. And now we're on a larger chart basis. We see that we're right in this little range, and focus in this area back here. Here's a big gap area. If we close, we are all the way down to that candle. So we're right in the middle of that area. So the path of least resistance in this seems to be all the way down to probably the 205 range. Right here is the bottom on this, and this is the beginning of that gap, 203. Maybe that's why we looked at selling that put spread. I have to admit, I didn't put this trade on personally. But with this said, this trade is looking really solid. And if you didn't have it on, I think it would still be okay to put something on. Move down to the 215 strike as opposed to buying the 217, and maybe sell once again that 203 strike put. And then if this starts trading for less than $1.70, if this withers away, but it's really holding its own here. March 21st, right? So in other words, it's still got a lot of premium in it. If I ever see if I sell this wide of a spread and I see this basically start getting down to 50 cents or below, I sometimes like to think about selling that or closing that out and rolling it up. So if the stock just kind of hangs around here, it's a way to bring in some more additional income to help offset some of the risk. Now, you obviously give up some upside, so you got to think about it. But say you sell this, or you buy and you close this, and it's trading for 50 cents or 30 cents, somewhere in that range, and you roll up to something that's trading for $1.30, pull in another buck, and you don't give yourself as much upside, but you also lower your cost basis on the trade. And it's just the way that I like to approach wider spreads. And some of the times I like to go a little bit wider because I know that I might do that. Now, if the market goes against you right away, that's not a good plan, right? Because you're not receiving as much up front. So there are always trade-offs. But if you're wrong on your forecast, you wish you would have set up the spread to start with. a little tighter, because you would have paid less for the spread and you would have had less risk. So if the market rebounded and went all the way back up to the higher end of the channel in IWM, that would be a bad trade. But this is an adjustment, and that's what the show is about, talking about adjustments, talking about trade setups, and what you might do if a trade goes with you and if a trade goes against you. Okay. IWM, we were out of the money call spread. We got a week in it, or I'm sorry, in NVDA. So there's still a chance in NVDA. So let me grab that trade. And in this position, we were looking, NVIDIA was at 132 and now it's at 122. And we bought the 139 and sold the 149. So yeah, we're at a 1 standard deviation move. We're still within that range. We went to, oh, not quite that far out. March 7th, not March 21st. Yeah. So now, yeah, we're quite a ways out. We got 28 cents for it. I mean, you could close it out right now and grab a quarter if you wanted to salvage your position. We paid $2.68 for the trade, and you could salvage the quarter. So we bought the 30 cents, that option contract, and then we sold the 149 is what we sold. So we could get 21 cents if you wanted to close it out right now. There's not too much that we could do here. And so this would be a situation, once again, so if the market goes against you like it did, and there was an opportunity, if you were quick, the market was up at the beginning of the day. For the first, I would say 15 minutes, NVIDIA was higher by around $5. So this trade was actually probably profitable at that point in time. And then, but you would have had to get out. You would have had to react really quick. So here's my thought about the same thing about having a wide spread. If anything, when the market opened like that and up $5, you could buy to close this one and roll it right down and make this, right now, this is a 10-point wide spread, make it a 5-point wide spread. Buy and close, because in the volatility crushed on it and was trading for a lot less, and then sell to open something like this and maybe bring in $1 for that trade and reduce the risk from 268 down to 168. That was feasible. You could have done that on the open. But now it's gone. So in this instance, there's no reason to adjust it. And that's what I'm talking about. If we would have did it a little tighter, we would have went ahead as much risk. We would have probably got this trade done for $2 instead of $2.68, right? And we'd only have a $2 loss on the position. So that's the way that I would approach it. There's not much that we can do with it. The stock just went through. NVIDIA did everything right, but the market just didn't want to reward NVIDIA. They even had issues with their newest chip and it overheating, and they have even mentioned that they fixed those issues. So there was really nothing that was said in the earnings report, or from what I ascertained from it, that would have made the stock go negative. And like I said, trading at 26 times earnings now. So much different. One of the lower valuations in the Meg 7 right now. There you go. So I'm going to look for the dead cat bounce again. And we just did this trade. And maybe I'm too obsessed with NVIDIA at this point in time, but I'm going to look to do this trade. So we're going to go out 14 days, and we're going to set up the front spread. So let me set this trade up for you. If you had 100 shares of stock and you do think that over the next 14 or 21 days, you can decide where you want to be. I'm going to set it up with 14 days. But these would be the two expirations I would consider. If you do think that the stock can come back and get closer to where it was before the earnings, which is the 132 level, this is a way to do a covered call on steroids. The fact that implied volatility is higher because they announced earnings and the market went down. So volatility in NVIDIA is higher. All the stocks are higher, including the market. And we're at 122 here. We're going to go a little bit out of the money. We're going to look at the 125 strike, and we're going to buy that option contract. And then we're going to go down and we're going to see where we can sell to and still pay for it. So at if we call this one 250, that would be about $5. It's going to bring in about 80 because you're going to multiply that by 2. And that's going to bring in about 80 cents. And if we go down to this one, yeah, I don't mind that one too. So that's 5, and that gives us $5. So here's what we're going to do this one. Yeah, like that's right at 250 right now. All right. 75-cent net credit. Okay. Now I'm going to send this to the what if calculator. And now this is a covered call. If I were to sell the 130 call, which is almost back. So the marketplace was at 132 ahead of earnings. I don't know why I'm thinking that's important, but for some reason I'm thinking just I don't want the cheese anymore. Let me out of the trap that the market might just get back to where it was at least over the next couple of weeks before that earnings report, before that a magical earnings report came out. And in this instance, we're short 2, long 1, 130. If we sold this outright, you would bring in $2.50. So keep that in mind because that's an alternative. You have 100 shares, you sell one call option against the position. You bring in $2.50, gives you a small pillow to land on over the next couple of weeks, and gives you a little bit of protection. But what I want is I want to get rewarded for the bounce back. So if you have 100 shares and you put this trade on, you're short 2 and long 1. So the question is, are you naked? Do you have unlimited risk like our what if calculator is showing you right now inside the Tradier Pro software? If you have unlimited risk, well, this is a very dangerous trade to do, right? But guess what? We already own 100 shares of stock. So if I click this little button, that whole thing goes from here to here. And now it's acting like a covered call, but from 125 to 130, it's like owning 200 shares of NVIDIA. So from this range to this range over the next 14 days, next 14 days, if you get a little bit of a bounce back, you can add $5 to your covered call position. And you're going to do this whole trade for a net credit of 76 cents. So if the market goes from 125 to 130, you get that extra $5, the difference between the strikes. And then you did this entire trade for a net credit of 73 cents. So you're talking about $5.73 that you can add to your 100 shares of stock if you get to move up. Now, if the market goes down, you still own that stock, and all that risk is from the stock, not from this trade. If you own NVIDIA and you don't want it taken away, that's the other risk, is you have opportunity risk from 130 all the way up. So if we're getting close to this strike and you don't want it called away, you have to manage that position. You could either buy it back or you could roll it out or whatever. So ideally, your best case scenario is probably that it just stops at 129, right? Because then you don't have to worry about it getting to the 130 and having your actual stock taken away from you. It's up to you. But 14 days, looking for a move back to where NVIDIA was before the earnings. Between 125 and 130, you could make a potential extra $5. If it goes up and the stock skyrockets, boom, and goes all the way up to 150, well, that's not a good situation. Now, one thing that I like about this trade at this point in time, I don't like to do a covered call before earnings. That's not a very viable thing to me to do before earnings, because you have this unknown event that's going to happen, and the stock can gap open, and it's very hard to adjust your trade. So when you're looking at covered calls before earnings, and I know that some people chase this scenario because you can go way out of the money. Well, you have all the downside risk of owning the stock, and you don't get all the upside because you're capping it. So if the news is bad, you take in all of it. You get all of the losses on the downside, and then you only get a little bit of the gain on the upside. Now, I don't mind that strategy, but I prefer not. I'd rather do it in this scenario where the market got beat up, volatility came down after the earnings, but it didn't come down a lot because the market got beat up after earnings. And this is when this trade is interesting. We did it not that long ago after the DeepSeek news came out and the underlying stock went down. Now, that one panned out well. As a matter of fact, we showed it on President's Day. We went through it because the market actually came right back to our short strike and expired right on it. So that was a very interesting trade, the way that one all worked out. And I think we were 6 points wide. And here we're going 5 points wide. You could actually go a little wider. Maybe I'll take the time. We got a few more minutes. And by the way, if there are any questions, please do put them in the chat box, and I'll be happy to address them. I see a couple here. Let's address those, and then I'll look at the 21st expiration and see if we can go a little bit wider and still get it done for a decent net credit. All right. So the comments. It was a good setup. Yeah, NVIDIA trade is the 327 expiration. And still got a chance. My put debit spread was right on target. Nice. It did close for a loss after the open. All right. So Doug, you protected did you have 100 shares of stock or shares of stock, or did you just do it to get bearish? What was your outlook, Doug? And I appreciate the comments. Oh, I just read the last part of it. You closed it right after the open. Oh, that's right. You had 30 shares, and I remember that. If I didn't close it for a loss right after the open. Yeah. And that it was just really weird. It was, I don't know. It almost makes you sad to basically anticipate what was going to happen with the earnings and everything with NVIDIA, and then get that outlook, and then the stock still got beaten up. You think if the news headlines just take one more day to come out, the stock probably would have ran the expected move to the upside, bluntly. But that's weird, Doug. You closed it right on the open, and actually you did the right thing, Doug. By the way, that makes sense. When you're doing an earnings trade, a lot of times I'll get out of the trade depending on where it's at. But if it's like kind of in that iffy stage, by 10 o'clock, you usually know. I'm in Eastern time, so it's a half hour into the market open. You usually kind of know which way it's going to go, or you get a feel for it. And a lot of times we'll close out a position if it's viable to close it. I actually did, and I'll share with you, I did a further out of the money call spread for about $1. And then I sold way out of the money puts because I didn't mind buying additional shares of NVIDIA down around 109, and went out a week. So the position's still on, and I'm not worried about getting the puts because the puts were at 109. So I was able to sell a 109 strike put and bring in $1, and then I took that $1 and I bought like a 140, 145 call spread. but I was doing it cash secured. I was willing and able to buy NVIDIA at 109 if the stock came down. So I actually ended up bringing in like 20 cents, I think I did, when it was all said and done. So it was a non-event for me. I needed the market to run up, and I obviously own the stock. So I'm still hurting on the stock position in that it's came down. I've owned the stock for a long time, so it's still at I owned it well before the split, but that's where I'm at. That's where I'm at with the trade. Okay, so I promised you one thing. I promised you that we'll look at this. So I don't mind this. This is 5 points wide. I like this trade. I'll probably do it again because I did do it the first time around on the NVIDIA's downturn. And like I said, I'd like to do them after the big event, but market went down, so vol is still up. It makes it more feasible to be able to get a trade done with this with a little bit higher volatility. Let's go back and look at the trading scenario. Go out to the 21st and see how much of a credit this one is. Okay, so yeah, so that's a $1.85 net credit. So what you do here then is you change it up and you give yourself some more upside. You don't need that big of a credit, in my mind. You don't need that big of a credit. So you take this and you go to 133, maybe 250. Yep, that's probably looking right. Let's see if that's a credit. 7 cents. No, I guess we do 132. And then that gets us almost all the way back. Yeah, 60-cent net credit. Okay, so if you add a week, it gives you a little bit more upside, right? Once again, the downturn started when the market was at 132.29, actually. Looking at my chart, 132.29. And this would get you all the way back. You basically say, that would definitely be the definition of a dead cat bounce. Market got beat up, no real reason. News headlines. Fundamentally, the company is strong, and even with the products that it's offering, and with the products and the forecast for the new chips that they have, and their progress that they're making, and the fact they fixed a problem on, I think it's called the Blackwell chip. I don't want to misspeak on that. It's something like that. And they fixed the overheating issue on it, and all this. So now you're at 7 points. You got 7 points of upside. So if you look at the March 14th expiration, you only got 5 points. It means that if the stock ran back to 30, you would make an additional $5. Here, you would make an additional $7 on that trade. All right, no questions or comments from here. I think we're at the end of the show and end of the week. What a crazy week. See if the SPX next week can get back to that 6,000 level. And yeah, we'll consider the weird door on Monday, but I don't know. The marketplace is just kind of crazy. Do you guys want to get bearish in the SPX next week? You want to look at a bearish trade? I mean, that's the way I think I would lean. And that's it for this edition of Options Guide TV. I'm muttering, and I need to just close it out. We'll see you this Monday at 11 a.m. Eastern Time inside the Tradier Hub, hub.tradier.com. Follow me on X. My profile is at Brian Overby on x.com, at my name. And you can also track us inside the Tradier YouTube platform if you'd like to view the show there. Hopefully, see you Monday. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.